Thanks everyone. It's good to see so many uranium bulls turning up for today's lunch. Hopefully we'll get you a little bit more bullish by the time we finish this presentation. I work for Tribeca Investment Partners. We've been around since 1998. More importantly for today, we run a global natural resources portfolio. We have a listed vehicle on the ASX that replicates that, TGF. We have a credit fund that is also in the resource space, and as a result of a bunch of work we were doing in those existing funds, uranium flagged as pretty interesting to us. As we did a little bit more work, we got even more excited about it, and then looking at the sort of size of the market right now, it made sense just from a market capitalisation to spin out a concentrated portfolio approach to that. It started with a bunch of our own money and some key investors from our main fund, and as interest is picking up, so is investor interest into the strategy as well. So today we're just going to break through the nuclear industry. We'll start a little bit with the fuel cycle, go into a little bit about a lot of the myths and misconceptions that we often get when presenting a bull thesis. Talk a little bit more about the current market dynamics, especially now Section 232 is cleared, and then have a quick look at what we do and how we look at our investment approach with a case study as well. I think it's important, this slide's important for a number of reasons, just to remind everybody that the nuclear fuel cycle, it's not a spot market per se. You know, it's anything from 18 months to 2 years from mine mouth to reactor core, as the uranium comes out of a mine and goes through a bunch of those processes. So, you know, the whole mindset of the user market is much more long term than other markets where there's less processing needed to happen. And then, of course, this is a chart I'm sure most of you have all seen before. There has been both supply and demand related catalysts that have put a huge amount of volatility in the uranium price in the past, and as a result of a demand side in 2011, we've been in a protracted sort of bear market here. Just a very quick slide on the spot market. A lot of focus goes into where the spot uranium price is, and I think the best way to look at this is to remember back to the iron ore markets a number of years ago, where the majority of the activity was contracting. It was iron ore producers selling to steel mills on semi-annual or annual contracts, and sometimes even longer. And the spot market was a clearing mechanism. The uranium market's very similar. Most of the activity goes on contracting long-term with utilities versus suppliers. And there is activity in the spot market, but it's a very small number of players, and that can sometimes not exactly give an accurate picture of what's going on in the real market. When you look at the catalysts for the spot market, in our view at the moment, you know, obviously Cameco still needs to be in to buy 10 million pounds for the balance of this year. That is something the spot players are looking at very carefully to see their movement. Anytime they move, that the spot price goes with it. But more importantly, when we look at the chart here, it just shows a divergence between the spot price and two other prices in the fuel cycle, the conversion and enrichment prices. And as you can see, they've continued to move higher. What we don't have on this chart is the long-term prices, and the conversion prices have now gone above the long-term price, and the enrichment, the SWU prices are almost matched it. And that's a function where, in our view, the real market is starting to move forward with what it needs to do, while the spot market's getting carried away in a bit of speculation. A few common misconceptions. You have to bring uranium down to the basics, and that is it supplies nuclear power generation, which is, you know, clean, reliable baseload power. And when you look at the chart here, this is a long-term chart. WNA put it out, but OECD and a number of others have done the similar studies. It looks for a global electricity demand increase of 1.5% per year between 2015 and 2035. That is, it's very much a 1.5% doesn't sound like a huge number, but it's 1.5% on a very big number already. So if you look at this, they assume that nuclear balance stays at 11% throughout that. We think that's a conservative scenario. But even when you factor in that nuclear stays 11%, it's still a 40% increase in nuclear power generation just on that global electricity demand flow. Another misconception that you often have is that around environmental concerns, and obviously carbon is a big issue that the world's starting to take seriously. And when you compare here and look at the carbon emissions per unit of power from nuclear, it's down there at the bottom end towards the renewables. But again, you have to remember here, you're not comparing nuclear to renewables because nuclear is baseload power. So when you're comparing it to your natural gas, your oil and your coal carbon emissions, it's extremely carbon efficient. And then just some statistics here. China currently is 4.2% of their electricity generation is nuclear. If they were to switch that off tomorrow, they'd have to burn 90 million tonnes of thermal coal to achieve the same electricity, which would generate 280 million metric tonnes of carbon dioxide. And then when you look at the US, another perfect example, 20% of their nuclear supply, of their electricity supply is nuclear. And because of that, they avoid 550 million metric tonnes of carbon dioxide emissions. So not insignificant there. The other pushback we often get is with respect to reactor builds, that they're costly, they take too long, it's a massive upfront cost. And to a certain extent, until more recent time, that's been true. There's been plenty of examples of Western reactor builds blowing budgets, blowing timelines. But what you see here is you see that China and South Korea have become extremely efficient at bringing those costs and build times down. So when you compare the average nuclear cost compared to other electricity, the average nuclear cost is getting much more competitive. The other thing studies like this don't tell you is that you're now getting around 60 years out of a reactor life. So in that 60 years, your renewables need to replace themselves at least 2.5 times. So when you compare that on an outright spend, it's a very competitive. It's just much more competitive than people want to let on. The other thing as well is the cost of power generation. When they're in operation, the actual cost of running a nuclear plant is not very much. The fuel costs, total fuel costs, are around a third of their total cost. When you compare that with your other base load of coal and natural gas, it's 75 and 85%. So once they're up and running, not only do they last a very long time, but they're extremely efficient. This is always the pushback we get, anybody in this space. Inventories, global inventories are high. I've been in commodity markets for 20 years and seen a number of markets where global inventories have been high and the price is still going up. The question I think that people don't ask themselves is how much is actually available? We've taken, one of the great things about the nuclear industry, because it's so regulated, is there's a huge amount of information that you can actually find about the space, except when it comes to inventories. Most of the governments don't necessarily publish what they have because there's obviously a strategic nature in that. We've taken probably the very high end of the estimate at £1.8 billion, just so we can't get accused of finding data that fits our story here. And what we come down to is that what is really actually available to the market is probably around £75 million. There's going to be some double counting here between the pipeline and the utilities. But even when you look at the utilities, that European Union number is now under £100 million. Last year they decreased inventories. They weren't buying, they were letting contracts run down. The US have also decreased. European and US inventory levels at the utilities are down at more than 5-year lows because they just haven't been in the market. Demand. We hear this statistic a lot. 450 reactors in operation. 54 reactors under construction, 111 planned, 328 proposed. Give or take 1 or 2, that's a statistic we hear a lot. What we don't actually do is put it down to how much uranium does it actually require. So what we've done here is, on the left-hand side, is we've looked at the number of reactors currently in construction. So we've ignored the planned and proposed. So what's actually being built now and how much will they need? When you look at ex-China demand here, for example, it needs the equivalent of one more MacArthur River mine just to satisfy the yearly requirements for the reactors currently being built. So not the reactors in operation, just the ones being built. Needs another Cameco McArthur River mine. We're going to talk about Honeymoon a little bit later. You can see they're at £2 million. That only just satisfies India or the US builds. And we're ignoring here also the front loading. So when a reactor comes online, it generally needs between 2.5 to 3 years worth of fuel put in at the beginning to fuel it up, and then every 12 to 18 months it replaces itself. So we're even ignoring that statistic. So I mean, as you can see, just what's being built requires one of the biggest mines what's currently on care and maintenance, another one of the world's biggest mines to be in production. Which brings us on to China. China is building 18 reactors at the moment. Assuming the Namibian Husab mine can get to £8 million this year, they need more than one more Husab mine just to satisfy the future demand of the 18 reactors they currently have under construction. So, this got us excited. When we move on to China, we get even more excited. The one great thing about China is they tell you what they plan to do via their 5-year plans. And in that 5-year plan, they're doing their 5, their 10, their 15, 25-year plan. And generally what happens is they generally achieve it. In fact, if there is a surprise, it's because they've done more than they said they were going to do, not necessarily less. In their current 5-year plan, they have a target between 120 and 150 gigawatts of installed capacity by 2030. They're currently behind on that. The reason they're behind on that, they had no new reactor approvals since 2016. People thought China's not necessarily going to move forward with this. But as you can see here, in 2017 and 2018, a total of 8 reactors in China connected to the grid. So, and a few of those were what they call the Generation 3+. Some of the latest design technology was built in China, below budget and on time, and connected to the grid. So, it's hardly surprising that the authorities wanted to make sure that they actually connected properly, that they did what they were supposed to do before they went and approved the raft of new approvals. And as we saw at the beginning of this year, early in the year, China approved four new reactor construction starts, and they're expected to approve another 4 by the end of this year. And to keep to their target, they're going to do another 8 to 10 per year. You can see here on the combined, I've got 35 gigawatts of installed capacity in a grey. That's because to hit, from what they've currently announced they're going to do, they're only at the lower end of their 120 to 150 gigawatt band. So there's another 35 gigawatts to get to the high end of that band that they have to actually announce they're going to build in the next 10 years and do so. And to bring that into perspective on the uranium side, that's £17.5 million. Another McArthur River mine, again, to get just to the top end of their 5-year plan. Statistic here, by 2025, their uranium requirements will increase 47%, up to around £33 million, which is around £11 million more than they're currently consuming every year. And by 2030, it's going to be an almost 4-fold increase to 75 million pounds of uranium required per year, again ignoring the fact that they're front loading. So it's what got us extremely excited, because when you've looked through the last 20 years of China cycles, every structural change they've made, be it steel or whatever else, and steel's a perfect example because they've been short the input, they've been short the raw material being iron ore. It's the same here. China's got a huge reactor build program. They've got fantastic enrichment capacity, but they're short the uranium. They're not going to walk away. President Xi's moved from an anti-corruption regime to an environmental focus. And that includes, having a clean, low-carbon, base-load electricity supply to allow China to continue to move forward. So that's a really important slide. Japan, lots of talk about Japan. We talked about inventories before, 110 million pounds of inventory there or thereabouts in Japan. Japan's also made it part of their strategic energy plan to have 20 to 22% back online by 2030, 30 reactors. That's about 15 million pounds a year they're going to use. We see Japan as a net neutral. There has been a delay in some of their restarts. There has been court challenges to date. None of those challenges have been successful. But they have been a little bit slow to bring these reactors on. You know, it's our view that that's largely to do with there's some safety checks that they need to all to show around anti-terrorism, and once that clears, I think there'll be a good restart of Japanese capacity, which will just keep that inventory where it is. The majority of that inventory is fabricated fuel rods bought at much higher prices. The Japanese know they're going to be turning on, for a total of 30 reactors in the next 10 years. They're not going to be selling that inventory into the market. So we sort of look at that as a bit of a neutral. Move on to supply. Very topical. You know, I think this is a really important slide for a number of reasons, because it just shows the concentration of geopolitical risk, if you like. One of the concerns on 232 was around Russian state-sponsored supply, and if you include Kazakhstan in that, 54% of the supply of uranium last year came from those so-called Russian states. And it's important to put this slide up because you need to get into the mindset of especially the Western utilities again. You know, the US is the biggest consumer of uranium per year, the utilities, and the most important thing for them is securing pounds. You know, they want to make sure that they have the fuel, they have the availability so that to continue to operate. The second most important thing for them is diversity of supply, and that comes from both a country and a mine. You don't want to be taking 100% of your supply from a country where there could potentially be some political upheaval and suddenly that's gone. You're then scrambling. Likewise, you don't want to concentrate all of your future requirements from one mine. So, you know, that's the second most important thing. And the third thing, you know, which comes a little bit further down the line, is the price. If they have to pay a higher price, but they've satisfied those first two, then that's more important. So, you know, that's an important supply chart when you to get yourself into that mindset. And supply cuts, we've seen other markets. Relatively small supply cuts have resulted in some quite significant price increases. The chart here on the right shows the cumulative care and maintenance cuts since 2013. You can see there's almost 40 million pounds of supply cuts there. And again, you know, there's a slight misconception that the majority of this can come on easily, and that's not necessarily the case. Langer Heinrich put out recently you know, their restart plan. That's $100 million capex in a mid to late 2021. Cameco have made no bones of the fact that they would want the rest of Cigar Lake, their only current producing asset out in Canada, to be contracted fully, and then have contracting in for McArthur River before they restart. They both indicate that somewhere in the mid to high 40s is a price that might incentivise them to do that. And even then, Cameco, they moved on 500 staff. They need to re-employ those people, and assuming that the specialists they had are not available, they have to retrain them. So they're guiding for at least a 9-month process to restart, and a year one ramp up of only £4 million before getting to their capacity in the second year. So again, it's not an immediate comeback to some of these pounds. You know, they require money, and they're going to require some time to come on. And you know, of course, cost curve. This is a chart that gets bandied about in plenty of different presentations, and you know, some of them vary slightly, but the current spot price is a little bit high there. But then you could see, I mean, the grey areas here are producing mines that aren't producing at the moment, including McArthur, which is, you know, one of the lowest cost mines. Kazatomprom as well, that they're in the grey. The bit that we haven't greyed out is Cominhac in Urano mine in Niger that has announced that they're also closing down because of price and reserve depletion. You know, so the medium-term incentive price is still not necessarily even encouraging the pounds required for 2021 demand, let alone going forward as all of those new reactors come online. Another slide we talk a lot about, the utilities contracting. You know, as we said, utilities aren't looking for next year uranium, they're looking for 2024 to 2030 or longer. And you know, due to the low prices in the market, a lot of this contracting that they were putting on in 2011, 2007 even, were much higher prices. And because they've had a low spot price, they've just allowed those to run their course because of a belief that the pounds are available in the spot market more cheaply. So on an average blended basis, you know, we're doing okay, nothing's going to change here. You know, as well, we've had the 232, which has put a lot of uncertainty. There's not been a huge amount of contracting. Well, there's been almost none in the US and not much out of Europe. You know, however, ironically, non-OECD countries have been running around securing supply because, you know, they can see all this coming. And as you can see here, this is on 232, but you can see that the European and US utilities have been drawing down their inventories as well. So they've been letting their contracts lapse and they've been drawing down their inventories. Most utilities like to hold 18 months to 2 to 3 years inventory. So, you know, the drawing down is something that they have to replace. I think what's important as well when you talk about the utilities, you know, last year in Europe, France announced that there was 14 reactors that were scheduled to close down have now had an extension for another 10 years to 2035. I guarantee you, those 14 reactors at the beginning of 2018 were not contracting past that because they didn't think they'd be in existence. Mexico's got 2 reactors that are applying to double their life from 30 years to 60 years. You know, there was some talk that they've been out looking for some contracting recently for £2.5 million. India has announced a very ambitious reactor build program that it looks like they're sticking to again. Why? Because pollution's a big problem there. It's starting to become a real public issue for them. They've renegotiated their contract with Kazatomprom. They were sourcing £13 million over 5 years from Kazatomprom. That's now increased. So these Western utilities sitting here saying, you know, it'll be right, there's uranium around. Everybody else, the activity that you're seeing outside of the OECD utilities is indicating that they're not so sure about that. So they're wanting to lock things in. So 232, there's obviously, as I said, it's been what we call the handbrake on the market with respect to activity. President Trump recently came out and said that under the Section 232 investigation, he did not see that imports of uranium into the US were a national security issue. However, he's now proposed the United States Nuclear Fuel Working Group with 90 days to not just look at the uranium mining of the US domestic producers, but to look at the whole fuel cycle. Now that's bullish in our mind for 2 reasons. One of the concerns about 232 was around whether the president would follow a previous trajectory of imposing tariffs and sanctions on foreign imports. And so therefore, if you're a US utility or even a non-US utility but engaging in US dollars, can you, hand on heart, go and put a 10-year contract in with supply from a country that might be sanctioned under President Trump? So that uncertainty has been removed. The second reason so now they can start to have conversations about you know, going back to the actual real fundamentals of the market. Who's going to be in production? So who can I secure some pounds from? And assuming that I do a good enough job of diversifying geopolitically, then I can engage some of the countries that we talked about earlier that maybe 6 months ago they weren't wanting to touch. The second reason is the president has identified that the whole nuclear fuel cycle in the United States is not up to where it needs to be and is a national security interest. There's, from 2 perspectives. One, the Department of Defence requires domestically produced and processed uranium for their nuclear arsenal and their submarines and naval vessels and things, but also to maintain a seat at the table. So the results of that working group can only be either everything's okay, we're not actually going to do anything, or we need to do something to improve, which there's a whole bunch of US utilities that are complaining that they're not competitive to cheap gas, that the tariff structure around renewables punishes them because they're unable to bring their power up and down. So if the results of some of that are also in favour for the US utilities, it gives them more financial strength and certainty as to how much longer they're going to operate, and so therefore how much, you know, how further they can go out in their contracting and how aggressive they can be. So it just releases a lot of that sort of pent-up uncertainty around that. And so if we just look at how we've structured ourselves, some of the misconception, I think people looked at previous cycles and seen huge returns in some of the equities around uranium, and that has happened. What you need to understand is that a lot of that is froth towards the middle or the end of the cycle. We're still at the beginning of this cycle, so this is more of a patient approach, and utilities don't work in a hurry. They're not going to rush in and contract tomorrow. They've got a process to go through. It takes them some time to do things. So waiting for this magical utility contracting mad scramble in the market has not played out yet. So as I said, we just see the opportunities that it's almost going to be like a Sydney property market. It doesn't just sort of go slightly up; it just re-rates. That's why we're sort of in here nice and early. We don't need to spend too much time on that handsome fella. We've kept our mandate flexible. We've got a mandate to invest across the whole sector, and that's because it's not just uranium miners. There's access to spot, which we have at the moment via London-listed Yellowcake. There's opportunity to gain some leverage via derivative exposure to the physical markets, because that's an active market which is also going to benefit from a price uplift. There's other sorts of opportunities. There's an unlisted uranium royalty company. There's small modular reactor technology, which, by the way, is just ripping through at a rapid pace. United States, Canada, Russia, China, France, you name it. Every country is trying to be the first to get this small modular reactor technology out, and that's still realistically 5 to 7 years away, but the way some of these countries and governments are sponsoring these programs, you might be surprised that some of that moves a bit further forward. We mentioned before we have a debt fund in Global Natural Resources, so there's also financing opportunities for us in the uranium fund as well. Nuclear medicine, things like that, laser enrichment. If we focus here on the uranium miners, it's a pretty basic checklist. It's what we do across all natural resources. I think the really important thing when it comes down to uranium here, though, more important than the potential some other investments we look at in the other funds, is jurisdiction and permitting. Uranium it's topical. It's highly regulated. There's global agencies all over the place that want a part in that, and jurisdiction and permitting is really important. We've seen through 2 uranium cycles, there's enough resources out there. There's plenty of people that can point to a resource and say this is a fantastic resource, but is it in a good jurisdiction? And not just is it permitted to mine, but are there permits around to handle radioactive material? Are there export permits? Are they sign up to the signatories to be able to as a country to be able to do that? So that's important. And our view here, in fact, it's probably just a good time to flick over to our case study. I mean, we're a substantial shareholder in Boss Resources, their Honeymoon deposit in South Australia, and we're in it for a reason, because it ticks a whole bunch of these boxes here. It will be the first Australian producer to market, and it will be amongst a handful of new assets coming into production in this first wave. And why? Because it's at a good stage. It's brownfield. There's already sunk capex. It has produced before. It's in a great jurisdiction, South Australia. The only 2 uranium mines producing in Australia right now are in South Australia. It's fully permitted, and not only fully permitted at a mine level, but also with export permits. And there's a great timeline to production. If you think that you get a re-rate in the price, and there's an opportunity for projects like this to slip into the production spectrum, it's a great one from that perspective. Low cost, very easily digestible capex. And again, when you look at all the projects that everybody says may or may not come on in this cycle or the later stages of the cycle, the question you have to ask is the capex. It can amount to billions of dollars. And where's that money coming from? I mean, it's not your local bank who's necessarily going to say, I'm happy to finance a uranium mine into production. So again, the quirkiness of uranium means that that some of those assumptions that are thrown in front of you in presentations, you just need to question more. And so, as I said, $68 million capex, stage 1 or 2 to get 2 million pounds out. That's very digestible. And of course, management have got previous uranium experience. It's got a good resource and plenty of expansion upside potential. It's a perfect example. As I said, official broker coverage has a price target of 11.5 cents. I don't know where it is now, five and change. I mean, it's cheap on that respect, and the market hasn't even moved. So that's just sort of one example of how we look at it, and we are very much focused in at the moment as to who's going to be into production, how we can benefit from that initially. There's a place to have explorers and developers and in the portfolio as well. I think that whole idea of pounds in the ground valuation that a lot of the uranium miners have held on to for the last 9 years doesn't necessarily get rewarded so much in the first part of the cycle, but certainly the frothier side of that it does. So I hope that it's been informative and educational, that we've sort of got our view across as to why we think it's a good investment case, and if you are invested already in certain places, just be patient, because it will play off, and it's not a cryptocurrency market, but it does have the capability of having cryptocurrency-like returns over a longer period of time. It just needs to kick into gear.